Hey guys, got another special episode here with Scott Duke. He's the founder and lead mergers and acquisitions advisor with Opnroad. How you doing today, Scott?
Yeah, I'm super well. Derek, thanks for having me.
Awesome. I'm really excited for this episode. Scott's gonna be talking about all things, buying, selling businesses, how to value a business, who's gonna, could potentially buy a business, and how to make your business worth more, and things that you can do, actionable steps to improve the valuation of your business. So, without further ado, Scott, can you tell us a little bit about yourself, Opnroad, and your background in the space?
Yeah, for sure. Yeah, no, again, happy to be here. So Opnroad is what they call a boutique M&A firm, mergers and acquisitions firm. And we've got a team of 9 that operate out of British Columbia, although we do have a bit of a footprint in Alberta and a little bit of a footprint in Ontario. And we're expanding across the country here. And we're trying to be across the nation and a little bit in North America. But either way, right now, that's the size that we're at. And our team focuses on a day-to-day basis of helping business owners prepare and sell their companies. So that's what we do today. By way of background, I'm an entrepreneur. So I've had 11 companies. A lot of them have B2B or service-based businesses. So similar to Derek, the people that you work with. I've had a painting company. We did construction for a while. I had a lawn maintenance company. I had a property management company that kind of did all of the above under one hood and did vacation rental, short-term, long-term property management. So a lot of this work in the past before, and I'm certainly not naive to having a hammer in my hand or a staple gun or a concrete saw or whatever it might be. But this is where I've landed at the end of the day. We did have a company that our property management company, we grew that to a decent scale to the point where we sold it to a private equity firm. And when we talk about different types of buyers you can sell your business to, that is an avenue that people could use as an exit strategy. So I did that. And that's kind of what got me in the M&A space and the space of business brokerage.
Wonderful. Yeah, it's really something I think a lot of business owners, especially if you're in your first business, not really familiar with. You hear about it someday, maybe you can sell your business and, kind of cash out, or even if they want to transfer ownership or what have you. Really something important to be thinking, ahead of your time, as far as start with the end in mind and thinking forward of like, there is, a runway, as you'll explain later, of getting a business ready for sale, right? So just to get like the basic in there, what makes a contracting business sellable? What's the criteria to actually be a sellable business?
Yeah, for sure. Maybe I take it from a different angle and go, why did my companies not sell in the past before, right? So I did have a painting, like I said, I had a painting company, and the business was decent size. We had 25 staff, which in general, usually that's a pretty decent sized company when you're in the contracting space. That business would not have been sellable because it didn't have systems, didn't have processes. There was high turnover of staff, and it was relatively owner dependent. Like I was the person is going out there, I'm doing the quotes, I'm the one that's getting relationship with the client at the end of the day to kind of move stuff forward, to build that trust bond. They're going to work with our company. And so if you took myself out of the equation, which when business owners think about selling their business, essentially you're leaving the scene at some point, whether it's 6 months, 2 years, you're still leaving. So buyers looking at it where if Scott leaves this painting company, what's left behind, right? And in that particular instance, there wasn't much left behind if I were to have left. So that's probably the primary reason why companies don't sell. And that's certainly the reason why that company would have been an unsellable asset. At the time, I flew the boat that I didn't even know you could sell these things. And if I'd known, I probably would have done some extra work to make it sellable, because I had a good team at the time, and it was would have been a nice thing to carry onward. So that's one. The other thing that could be challenging in companies, and again, like I had a hot tub maintenance. Maybe the hot tub maintenance isn't a good example because it did have recurring revenue. Maybe more of our lawn service company, right? So that would every year we'd have to be renewing business with people to shovel or mow their lawns, right? And if I didn't renew a contract with them, then we would lose that business, right? So it's like constantly trying to refresh that business. The prime example for this is a home builder. So if you have somebody who's like building a home every single year, maybe they would do 1 or 2 homes. If there's a lull in the market and they don't have a home one year, it's like that company can go under in that 1 year that they don't build. So that's something that contractors need to watch out for, and why project-based businesses are sometimes more challenging to sell. Because if you don't have a pipeline of future business, then the buyer will step in day one and they'll be worried that they aren't going to land that next home the next year or the year after that, right? So that's probably the second reason why businesses that are in the construction sector have a difficult time selling. So that's coming at it from maybe the wrong angle. That's the angle of like why things don't work, but you can kind of that pretty easily and figure out what to do to make them work.
Yeah, it makes sense. And owner dependence is the big thing, right? For contractors specifically in the construction business, because it is, project oriented, and you do get, seasonal, but also just economic, ups and downs and things like that. So having some systems and some management in place and consistency is kind of what I pulled out of that as far as, improving the sellability, the ability to sell the business. So you mentioned before about potential buyers. So say you met that criteria, you've thought ahead, over the years, you've planned your business to be sellable. Who would be in the market to buy a business that has those systems and not overly owner dependent?
I know you're going to include below a link. You'll have my email and that kind of thing. We actually put together a sellability guide. It shows kind of start to finish what you should be doing in your business from a sellability perspective. But it works with this question, because this question is, who are the buyers who potentially acquire a business when you're looking to sell? That breaks down. We break it down into 4 stages. So we have the stages of growth in a business basically break into stage 1, stage 2, stage 3, stage 4 companies, right? And so your stage 1 company is the business that's doing under $1 million a year in sales, probably even less than that. Maybe it's doing under $500,000 a year in sales. It maybe has 1 or 2 employees, maybe 3, 4 employees, something like that, but it certainly doesn't crack over 10 employees. That's the vast majority of companies, period, in the marketplace. So it's about 87% of businesses live in that category. In that category, you're going to be selling to an individual investor who's going to be an owner operator. So they're an individual that's going to be stepping into your shoes, taking over your business, doing your job on a day-to-day basis. So what you want to do in that, when if that's where you're at and you want to get out of your business, you need to make your job as attractive as possible, because the new buyer's coming in and stepping into your job. So what makes a job attractive to somebody? If you think about going and searching for a job yourself, so you want to get as much pay as you possibly can, and you want to do as little work as possible. I guess you narrow it. Okay, so that's what would be the most attractive job, right? Best case scenario, I get a high salary, I don't even have to show up. So if that's the kind of the gold star or the North Star that you're shooting for, really what I find with business owners that are at that size, oftentimes they're working 40, 50, 60 hours a week in their business. So you want to do the job of reducing the amount of time that you need to work in your company. And this is systemization and like a delegation to your team members. And then you want to pay yourself as much as you can, right? Or at least showcase the business can pay yourself a lot, because anyone who's wanting to buy a job certainly wants to be making at least $150,000, $200,000 a year in that new job, because the opportunity for them is they could take a job somewhere else and probably make equivalent money, right? So that's stage 1 companies. And I won't go all the way through, to stage 4, but as you get closer to stage 4, like stage 2 and stage 3 businesses, you start to unlock what I call the door to the private capital markets. So this is where institutional investors show up. And these are businesses that are usually doing $3 million to $10 million a year in revenue. This is the sweet spot where OpenRoad lives. It's where we can really drive a lot of value for clients. But that's where private equity firms show up. And private equity, for those that never heard that before, it's just basically a business that buys businesses. So that's what they do. And it's where competitors, so like larger businesses are gobbling up smaller businesses, it's the bigger companies that are interested in the businesses that are doing around $3, $4, $5 million in revenue a year. So then that's where you start to attract those particular types of investors, and their funds, they put funds of money together that go out and acquire companies. So if you can unlock that door, that's where you'll certainly earn a lot more. There's a lot more value potential selling to those particular types of buyers.
Yeah. Makes sense. So depending on what stage of business you're at, there's different people, different strategies, I guess, essentially for selling the business. And like you said, Scott, so if you want to find out more about OpenRoad or connect with Scott, check out the links in the description below, and there'll be links there to connect further. Moving on, how much is my business worth? So that's probably what a lot of people are wondering. I do whatever, this much revenue, I'm in this location. What's the business worth? So how do you figure that out, or how can people wrap their heads around business valuations?
Yeah, for sure. So we spend a lot of time at OpenRoad building proprietary tools that allow people to answer this question really quickly. So for those that want to really nail this one on the head, this is work that we do free for people. And again, just connect with us and we'll set up a time and walk through a free valuation for you that is highly detailed. But it's actually not that difficult. So I think I can describe it quickly. I've never described it right on a podcast before. So for those I'm going to do it. So we'll see. Here we go. Right. So what you want to know is you want to know the earning potential of your company. So the earning potential looks like taking your profit and loss statement last year, going right to the bottom and looking at your profit. So this is pre-tax profit. And then you want to look at your amortization and depreciation. For those in the construction industry, you're going to have a lot of that. So you want to take that number and then you want to add that to your profit. Okay, now we're getting closer. And then any interest you paid on long-term debt. Again, that's on your P&L statement. So any interest you paid on long-term debt, add that as well to your profit. Now, for those of you out there that are running extraordinary expenses through your business, you did a home reno at your house, or you use some of your team to put a pool in your backyard, or you have 3 vehicles that the company pays for and you only need 1 vehicle, one's a flashy vehicle. All that extra stuff you're running through your company that does not need to run through your company for the company to operate, add that back as well. Now you're at your true earning potential of your business. Once you know that, depending on the size, you multiply. If you're a stage 1 company, multiply that by 2. If you're a stage 2 company, multiply it by 3. If you're a stage 4 company, multiply it by 4. If you're a stage 5 company, multiply it by 5. And that's the value of your company.
Yep.
So yeah, if you, again, the sellability guide will show you all that, but that's exactly how you value a business. It was the first time I walked through in that detail on a podcast. Normally I'll say, it depends. And like, you got to think about risk and you got to think about this and that. But for the most part, if you just want a back of the napkin value of your business, just rewind the podcast to what I just said, and then take your earning potential, which is called EBITDA, but I just told you to calculate, and just multiply that by 3.
Yeah. Perfect. Thanks for sharing that. And if you don't want to go through all the math, connect with Scott. I've seen some of the tools that you guys have developed. And of course, there's a lot more factors that go into it to give a more defined, scope of the business as far as health and valuation and everything. And it's quite impressive, the setup where you can plug in, some of the numbers of the business, and it essentially gives you a ton of data to pull from. So we kind of know what our business is worth today, or could possibly be worth, in the near future. How can people improve their valuation of their business if they're, let's say wherever they are, whether it's $500,000 or 3 million, and they want to, increase it by 50% or 100%, like what do they need to do to improve their valuation? Yeah, for sure. This is important. This one was learned with blood, sweat, and tears for me, and lots of tears for the companies that didn't sell. There's only 3 levers you can move. So this is what's nice about it. Everyone's okay, increase the value of your company, do this, do that. It's like there's 3 things you can do. So you can increase the size of your business. And this looks like increasing your revenue. So it's driving more business. This is the one that we all know. It's a known. Obviously, my company will become more valuable if I increase the size of it. The second lever is efficiency. So that's about driving more to the bottom line. So if you look at your company, not all companies are apples to apples, right? If you look at your business, the question is, how many pennies am I keeping out of every dollar that I earn? So if I earn $1 and I keep 5 pennies, that means I'm running at a 5% profit margin. What people oftentimes don't know, myself included, this took until company 6 to figure this one out because I'm a slow learner. But if you're doing a 6% margin, that means you're keeping 6 pennies out of every dollar that you make. Obviously, the companies that keep more pennies out of every dollar are worth more. So you want a company that has higher profit margin. So you want to be doing everything you can to improve the efficiency of your business, to drive more to the bottom line, to increase that profit margin. That's what is a big driver of value in companies. And I would argue that might be the strongest lever if you're to pull one lever, is the efficiency lever. Then the last one that you have available to you is the multiple that you sell for. So what's the multiple that some buyer is going to pay for my business in the marketplace? And the way that you increase your multiple is by reducing the risk. So the easiest way to think about this one is on publicly traded stock. Like when you're trading your company, at the end of the day, you're trading your stock. You're selling it in the private capital marketplace. And it's no different than selling stock in the public capital marketplace, which is going out and buying a publicly traded stock. When people do that, they're analyzing the risk of this business. And what they're actually analyzing is like, what's the risk that the income that this company is generating is going to reduce less in the future. And if that risk of that happening is high, then people will pay less for that stock, which is no different than your company. Your company is the exact same. It's not accessible to trade in the public markets. You have to trade in the private markets. So you want to think about your company from a risk perspective. That's what increases the last lever, which is the multiple that people will pay for your business. And we touched on a couple of those things so far in the podcast, like owner dependence and customer concentration, or do you have repeat business, or is there recurring revenue? Like these are the kind of things that people look at. And in Opnroad, we'll look at about 45 things to fully diagnose the riskiness of a business. And then owners can go back through and fix those things, improve the risk profile of their company, and then it's worth more. So you have all of those 3 levers kind of firing off, and you have the most valuable asset you could possibly have. Yeah. Awesome. So just a bit of a follow-up question. So there's definitely, a lot of different ways you can improve. Like there's those 3 main things, but underneath each of those, there's a lot of stuff there. For you guys in your client journey, you have someone who contacts you. I know it's going to be different for every business, but what does a timeline look like essentially for a business sort of getting ready to sell in the future? Yeah. So I would say, okay, when you take your business to market, going to market and actually getting cash in your bank account can be a
a 6 to a year long process if, with a big asterisk that is in front of this if your company is sellable. So a lot of the work that we do is upfront connecting with the business owner and doing a quick diagnosis to determine sellability. And then if their business isn't sellable, it's not the end of the world. And again, I've had lots that weren't. Then you just go and do a few things to make it sellable. And that's where people can work with yourself, Derek, to actually go and do that work to make a sellable asset. But if you have a sellable asset and you haven't done any market preparation, I would honestly, to maximize value, depends where you're at. Like a lot of people they're done. Like they come to us and they're just get it gone, and that's not a method for maximizing value, but it is a method for solving a problem, right? If they have time, then I would suggest 2 years of planning. And the primary reason for having 2 years is that if you know what you need to do, then you can have your books indicate that having 2 year ends. And that's what people are looking at when they're valuing a company. They're really looking at your year-end financials. And for most of us entrepreneurs, we're maximizing, minimizing tax. Like that's what we're focused on, right? We're like, want to pay as little as tax as possible. But when you're looking to sell your company, you want to flip and do the opposite, right? You want as much as possible to follow the bottom line, pay the highest taxes you possibly can, because when you sell your business, and by the way, in BC and Alberta, it's like we're paying around, if you're making under $500,000 a year in profit, you're paying around 12% tax, right? So for every dollar you make and you claim, you pay 12% of it, like 12 cents of that dollar goes to the government. When you sell your business, it's a multiple. So you get every dollar that falls to the bottom line, you get $3, $4, $5 for every dollar that falls to the bottom line. So it's a fool's game near the end to try and save 12 cents to lose $5. Like everyone can understand that. So it's 2 years before you want to sell, you want to have your financials in the best order possible to maximize value. So that's why 2 years is a nice timeline. And if you know what you need to do, then you can do that. And some of those things do take time. Like if you need to put a general manager in place, or if you need to put a new marketing or sales system in place, these things don't happen overnight. So you want a little bit of time period for that. And then when you go to market with your sellable asset, you're usually 6 months. So that's the time.
Thanks for explaining that. I think the big takeaway there is, think ahead. And even if you're not planning on selling your business in the next year or two, why not get it to a sellable place where you can pull that lever, push the button, 5 years, 10 years down the road, whatever it may be, and have your business, kind of ready, packaged to go and get the most value. So make sure you reach out to Scott. Scott, what's the best way for people to connect with you? If they want to.
I know in the show notes you'll put my email down there, my LinkedIn profile. If you forget that and you're just in your car or something, then if you just type Scott Duke into Google later, my name's relatively easy to remember, Scott Duke. Then you'll be able to find me, and always happy to connect and always happy to do evaluation for people.
Perfect. Thanks so much for sharing your expertise and taking the time out to help us with learning more about selling businesses, Scott.
Yeah, thanks so much for having me on.